Hi, it's the Fat Day Trader here, and welcome back to my channel. I'm excited for you all to be here, especially today, because I'll be talking about the best time to trade Forex. We'll be looking at the three major trading sessions and throw in some variables that you'll definitely want to consider. If you want to catch those big price moves, you've got to stick around for this one. So, buckle up because I'm about to spill the beans on when the best time to trade Forex is. Please bear in mind that I don't provide investment advice and all my material is made available for your education purposes only. And please, if you haven't already, hit the like and subscribe buttons. I really appreciate it and it helps out the channel. Thanks a lot. All right, let's get stuck in. As you know, you can trade Forex 24 hours every day, from Sunday 10 p.m. to Friday 10 p.m. GMT. And the trading day is divided into three major sessions. These are the Asian session, the European session, and the US session, which all have different trading characteristics. The Asian session starts from midnight to 10 p.m. GMT. Keep in mind that the volume might not be as high here as it is in other sessions. Then we have the European session, which starts from 7 a.m. until 5 p.m. GMT. This is a crucial session with substantial trading activity. And then finally, the US session, which starts from 1 p.m. to 11 p.m. GMT. This session is known for fast-paced movements and significant market activity. Understanding these sessions is essential because they set the stage for when the market is most active. Now let's talk about those times when the sessions overlap. These are the times when the trading sessions are open simultaneously. First, you have the European and Asian session overlap from 7 a.m. to 9 a.m. GMT. It's a short but powerful overlap, which brings in the first significant burst of liquidity and price volatility. Then we have the European session overlapping with the US session from 1 p.m. to about 5 p.m. GMT. This is a more extended overlap, and things get even more exciting here. It is generally considered to be the most important because during these hours, overall liquidity in the Forex market is at its highest. There are elevated volumes observed in the Great British Pound, Euro, and the dollar, because these currencies are native to these regions. During these times, you can find the greatest volatility coming into the market. So there's more liquidity, more volatility, and more price action now compared to the Asian and European session overlap. For example, during this session overlap, you have more multinational corporations transacting currencies to facilitate international transactions and commerce. You also have the hedge funds and investment funds trading for speculative purposes and hedging their investment portfolios. And finally, you have the banks that trade a lot of money on behalf of their clients, facilitating global commerce. This increase in activity often leads to increased volatility, and as traders, that's what we are interested in. When we enter trades, we want the price to move a lot. So it makes sense to optimize our trading strategies around these times. There is less volatility when Asia transfers to Europe than when Europe transfers to the US. So based on this, it's pretty evident that if we have to choose between these two overlaps, I would rather be trading during the European and US session overlap. If you are a range trader or are located in Asia though, then obviously you might want to choose differently. But bearing in mind that most traders trade momentum strategies, it seems evident that you should choose the European, US session overlap to benefit from this increase in volatility. Each of these sessions and their overlapping hours will present different variables that can affect the instruments being traded during those hours. For example, traders will typically find that currency pairs domicile to these regions are most active when the session is active. For example, the Great British Pound versus the USD and the Euro versus the USD will likely experience the most volatility during the overlap of the European and US sessions. The Australian dollar versus the Japanese yen will be most active during the Asian session. You will see that most significant price moves start during this session. Another variable is that of volatility. Volatility refers to the rate of change in price movement in a currency pair. During periods of high volatility, the currency pair can move significantly during short periods of time. High volatility often requires a higher risk threshold, with stops that are farther away. Volatility also presents the most opportunities for profit if the pair moves in your favor. On the other hand, low volatility is when prices move less dramatically. Yes, it might be better for some strategies, but the opportunities for substantial gains are usually lower. Understanding the volatility of the market during different sessions is crucial. Another variable to consider is liquidity. Liquidity is related to the amount of currency being transacted. The more volume being exchanged, the greater the market depth is said to be. And this means that traders are able to exchange large volumes of currency effectively and get in and out of the market with ease. Liquidity also affects your ability to execute. Low levels of liquidity can often lead to difficulty entering or exiting the market without experiencing slippage. So as a general rule of thumb, you should trade during times when liquidity is high, especially if you trade in large lot sizes. Because hours when liquidity is low is potentially problematic and the price does not move as much. If you're a trader who's looking to avoid taking excessive risks in low liquidity sessions, you should seek to steer clear of certain times. These times are typically during the Asian session or when the US session is approaching its close. Although the market is technically active, the hours just before the market's close and right after the markets open suffer from low levels of liquidity. This is due to a reduced number of market participants. Another time to consider is bank holidays. You want to look out for national holidays in the US, Europe, the UK, Japan, and Australia, because on these days, liquidity could be a problem, especially if two or more of these countries have holidays on the same day. So here's the point. As a general rule of thumb, the best times to trade are when the market is highly liquidity, during the European and US session overlap. These are the times when the market is peaking with activity, and you can also execute your trades more effectively. I understand if you want to trade during your natural waking hours, but the markets work on their own time. You may have to adjust slightly if you want to find better trading opportunities or change the currencies that you trade. For example, if you're based in the UK and you can only trade in the evenings after work, you may find that trading in the Australian dollar and Japanese yen is better. Instead of catching the tail end of the session that would primarily involve the Great British Pound and the United States dollar. If you are based in Asia, then you might want to consider trading European and currencies paired with the United States or Canadian dollar when you get home from work, as these currencies will be highly active during the European and US session when you get home. I hope that makes sense, and I want to finish with this. What works for one trader might not work for another. It's essential to experiment, find your sweet spot, and align what you trade with its peak trading hours. Knowing what to trade and when to trade it can make all the difference to your results. So try this out and let me know how you get on. Thank you for watching, and I hope you found this video useful. Don't forget to hit that like and subscribe button, and I will see you in the next one.